Hello students, welcome to Byju's IAS. Very often you must have heard or read the statement that India is the largest economy or growing economy in the world. India is the seventh largest at the current market rates and the third largest on PPP, purchasing power parity terms. Every day in the newspaper, I'm pretty sure you must have come across the term or the short form GDP, gross domestic product. Now, what do you mean by all these concepts as well as the meaning of the statements? Today, we will understand that by looking into a chapter on national income aggregates. Now, what I'll be discussing under this is basically we'll start with why do we need to measure aggregates, that is, national income aggregates. The most important one that I'll be using is GDP. Why do we need to measure this? What is the importance of this particular measurement? What are the types of national income aggregates? Within these types, we'll focus on the concept of a GDP that is very, very important from the exam perspective. And within this particular GDP methodology, we'll also have a look at the latest GDP methodology. Then we'll look at the concept of a GDP deflator, per capita income, the very important current affairs concepts of pro and counter cyclical growth, and a vicious and virtuous cycle of a growth. And once we have seen all of these particular concepts, we'll try to look at the questions which have been asked earlier in the UPSC on these particular concepts in the prelims as well as in mains. Now, with this particular introduction, let me start with the concept of why do we need to measure, let's say, the production in the economy, or the most important term, GDP, gross domestic product. Now, please understand certain very important reasons why we measure productivity in terms of economic growth is one, we want to make a comparison. Comparison of what? Comparison between India's performance presently and India's performance in the past. For example, you must have heard of the statement India's economy grew at a Hindu rate of a growth post independence till 1990s. Now, the term Hindu rate of a growth basically refers to a conservative GDP growth rate of 3.5%. But post 1990, because of various reforms implemented by the government, especially the LPG reforms, liberalization, privatization, and globalization reforms, the growth rate in the Indian economy has been much, much higher. So you want to have a comparison with respect to how the Indian economy is performing today and how it was performing, let's say, in the last couple of decades. Second, we also want to make a comparison between the performance of Indian economy with the other countries also. For example, you must have heard of G20 countries. It's a grouping of 20 countries. Within this, we want to make a comparison between India's growth rate with other countries. We also want to make a comparison within BRICS economy, that is basically standing for Brazil, Russia, India, China, and South Africa. Within this particular grouping also, we want to make sure how Indian economy is performing. Third, we also want to ensure that whatever is the need of the policy or whatever changes are needed in the policy are done in order to achieve higher GDP growth rates or higher productivity in the Indian economy. For example, in the last couple of years, Government of India has introduced various reforms such as Make in India, Startup India, labor reforms, LPG reforms, so on and so forth. What is the importance of these particular reforms? Ultimately, we want these particular reforms to boil down to contribution in terms of a higher productivity or higher production in the Indian economy, which essentially means we are achieving higher GDP. And apart from this also, there is also central banker. In case of India, the central banker is Reserve Bank of India. This particular Reserve Bank of India is formulating a policy. Now, please understand this. The policy formulated by Reserve Bank of India is referred as a monetary policy. Now, you do not have to be worried about this particular concept of monetary policy right now, because under the concept of a banking, we'll discuss RBI in detail, and within RBI, the most important concept for you will be monetary policy. Generally, in case of Indian economy, or for that matter, any economy, there are two types of policies. One is the fiscal policy, which is formulated by the government, and the second one is monetary policy, which is formulated by the central banker. Now, the decision making in terms of fiscal policy as well as monetary policy is also very important in order to ensure that all of these particular policies in one or the other way, or directly or indirectly, will have an impact on the overall production in the Indian economy, which will lead to higher GDP growth rate. Now, I know that I have not yet covered the concept of a GDP. Please hold on to it. I'm just trying to tell you the introductory points related to why do we actually measure these particular aggregates. What are the different aggregates which are used? There are 5 different aggregates, but out of this, the most important aggregate for you will be GDP. Now, these particular 5 aggregates are 1. GDP, gross domestic product. Second one is GNP, gross national product. Third one is NDP, net domestic product. Fourth one is NNP, net national product. And the fifth one is national income. We'll start with the GDP, which is the most important one, and we'll cover everything related to GDP. And after that, whatever is required from the exam perspective with respect to other aggregates, we'll have to look at all of these particular aggregates in that particular context. Now, let me start with the first very important concept, that is a gross domestic product. Now, what do you mean by gross domestic product? Understand this. Let's start with an example here. Imagine this is a particular country. Either use the term country or I'll use the term economy. Okay. So imagine this is a particular economy. Within this particular economy, there will be companies, there will be individuals, there will be MSMEs, micro, small, medium enterprises. There will be certain units which are started by the owners themselves, that is self-employed units. So in this particular economy, whatever is the overall production of goods as well as services. Is it okay? I'm considering a particular economy, and within this particular economy, whatever is the market value of all the goods and services. I'll repeat the statement here. In this particular economy, whatever is the total market value of all the goods and services which are produced in a specific time period is called as GDP. I'll put it in statement again so that it is clear for you, and this is important to understand. Within a particular economy, or else they will use the term territory, whatever is the market value of all the goods and services which are produced for a specific time period is nothing but GDP. Now imagine in this particular economy, 10 goods have been manufactured, and the market value of these particular 10 goods is, let's assume, 10 rupees. I'm just taking simple numbers here. So 10 goods, market value per good is how much? 10 rupees. So total market value of goods and services produced will be how much? 100. So this is nothing but a concept of a GDP in this particular example. Now there are certain points to be understood here. First, whenever I say market value, what do you mean by this? Whatever is the market price at which the goods are sold and bought in the market is called as a market price. Now, there will be certain goods which are also referred as intermediary goods. What do you mean by intermediary goods? Understand this very carefully. In case of the concept of intermediary goods, these are nothing but the goods which are used in the supply chain process or in the overall production supply chain. Let me give a simple example. Imagine here is a car being manufactured. To manufacture this particular car, you will require thousands of raw materials. Let me take the example of a tire. Now, to manufacture this particular tire, you will require rubber. Now, have a look at this. Rubber is first produced, and this will be converted to tire. Tire will be used to manufacture a car. Now, what we purchase in the market is nothing but a car. So, what final consumer purchases in the market is nothing but the concept of a final good. But to manufacture the final goods at various steps, there are different raw materials or intermediate goods which are required or which are used. Now, always remember this. Whenever I say market value, I'm not considering the market value of these particular intermediate goods or raw materials. I'm going to consider the market prices of these particular final goods only. If you ask me, why, sir, why are we exempting these particular intermediary goods? This will happen for a simple reason. If I count the price of intermediary goods as well as the final goods, that will lead to double counting. What do you mean by this? Let me take a very simple example. In this particular case itself, if I count what is the market price of the tire, and also count what is the market price of the car, is it okay if I say that the market price of the car will be arrived after considering the cost or the price of the tire itself? Because obviously when I purchase the car, the tires are the components. Tires are already fitted. So when the car is sold to me, whatever the price is, out of this particular price, the market price of the tires also has been accounted for or has been included. Now if I count the tires also separately, car also separately, then that will also lead to double counting. So we generally don't consider whatever is the market price of the raw material consumed, whatever is the market price of the intermediary goods consumed. We directly count whatever is the market price of the final good. And next very important point, whatever goods are resold in the market prices of these particular goods is also not counted. Let me repeat it. The goods which are resold in the market, the market prices of these particular goods will not be recounted or will not be counted in the calculation of GDP. Why? Imagine a particular good. Let's take the example of this particular pen itself. So I'm a final consumer of this particular pen. Now, this particular pen, imagine, was manufactured last year. So when this particular pen was sold by the company to me, it already is a part of a GDP of last year. So if I resell this particular pen to you people, imagine you will pay X amount of rupees for this. This particular pen is not produced in this year. You can understand this. The pen has not been produced in this year. Rather, the pen which has been produced earlier has already been sold in the market is being resold to you. So any goods which are being resold in the market, the prices of these particular goods will also not be counted in calculation of GDP. In the same way, the transfer payments are done by the government is also not counted in the calculation of a GDP. Now, what do you mean by transfer payments? Government will provide certain support in the form of a transfer payments to beneficiaries. For example, pension, for example, scholarship. These particular transfer payments are also not counted in the calculation of a GDP. So remember these particular points with respect to calculation of a GDP. The next very important point, I said that GDP, gross domestic product, is the market value of all the goods and services which are produced in a specific time period. Now, what do you mean by this particular time period? Remember this very carefully. We calculate GDP for a quarter, we calculate GDP for a half a financial year, and we also calculate GDP for a full financial year. Now, what do you mean by all these three terms? Understand this. Whenever I say calendar year, this particular calendar year will start from 1st January and will end on 31st December. Whereas this particular calendar year is not chosen as an accounting year or a financial year in case of India. Rather, what we do is we'll start our accounting year or a financial year from 1st of April, let's say in this year, and we'll continue this till 31st of March of next year. So I'll repeat it again. The financial year in case of India, which is used for accounting purposes, will start from 1st April of this year and will continue or will end on 31st March of next year. That 1 year or 12-month time period is considered to be a financial year. Now, this particular financial year is broken down into 4 quarters of 3 months each. For example, have a look at this. I said the financial year will start from 1st of April. So, April, May, June is 1 quarter. July, August, September, 2nd quarter. October, November, December, 3rd quarter. January, February, March is the 4th quarter. Is it okay? Just like this only, we'll take 2 quarters, merge them, we'll make it as half a financial year. For example, 1st quarter plus 2nd quarter is first half of financial year. Then 3rd quarter and 4th quarter will be 2nd half of the financial year. Remember these particular concepts. Now, come back to the original concept here. The GDP is measured for a specific time period. That is, we measure GDP for half a financial year, quarter of a year, or quarter of a financial year, or full financial year. Now, this particular concept of measuring GDP quarter-wise, remember this particular statement also. The concept of measuring GDP quarter-wise was started back in the year 1996. Until that, we did not have this concept of measuring GDP quarter-wise, but post 1996, we have been measuring this particular GDP quarter-wise also. And that is the precise reason very often you will keep on coming across the statement saying that in the first quarter, GDP has contracted or GDP has expanded, so on and so forth. But before I go forward, one more very important point with respect to quarter-wise GDP. Whenever they give you data with respect to quarter-wise GDP in the newspaper, always remember this, they are making a comparison with respect to the same quarter in the financial year or the previous financial year. Now, what do you mean by this particular statement? Let me give a simple example. Imagine for the first quarter of a financial year 2022, they are telling you the GDP data. They'll simply say GDP growth rate is this much. Now, what do you mean by this? It simply means they're comparing the first quarter data of financial year 2022 with the same quarter, that is quarter 1, but for previous financial year. Previous financial year was financial year 2021. So this is how the quarterly wise data is published in the newspaper. Do not get confused. Now let me go forward. As of now, what we have seen, we have taken care of what do you mean by GDP? GDP is gross domestic product, market value of all the goods and services which are produced in a specific time period in a particular economy or in a particular territory. Now, how this particular GDP is measured? GDP is measured under 3 methods. These 3 methods are output or product value method, income method, expenditure method. Is it okay? Output or product value method, or some books will say production method. Second one is income method, and the third one is expenditure method. Now, before understanding this, please understand this statement very, very carefully. Whether I calculate GDP through first, second, or third method, the GDP value will remain same under all the three. Is it okay? I'll repeat the statement here again. Whether I calculate GDP through production method, through income method, or through expenditure method, the value of GDP will remain same under all the three. Now, yes, understood that difficulty is in terms of a calculation and there will be certain discrepancies, but the NSO, National Statistical Office, this is the main authority which is involved in the publishing of the data related to GDP, will use certain adjustments to ensure that the value will remain same under all the three heads. Why the value remains the same under all the three heads? To understand this, there is a concept called as a circular flow. Now, what do you mean by circular flow? I'll use a statement, then I'll give an explanation here. The expenditure of one is an income for another in the economy. What do you mean by this? Follow the example very, very carefully. Here is a household and here is a manufacturing company. This particular household will provide labor services to the company. Now, what do you think manufacturing company will do the labor? Obviously, it will produce goods or services. So have a look at this. The company has manufactured either goods or services using the labor. Now, for having provided labor, for having supplied the labor like this, the household would also expect something in return. That is, it actually wants what? Wages. So have a look at this. From one side to another side, from the household to the company, the labor has been supplied. And in return, this particular company has supplied or paid wages to the household. So on one side, goods and services have been manufactured, and on the other side, the households are sitting with wages. Now, don't you think the households will require goods and services for consumption? For example, households will require food articles, households will require milk, households will require oil, atta, so on and so forth. So what will happen? Households will use these particular wages, pay for these particular goods or services. Households will use this particular money, pay for the goods or services, and on the other hand, the company will supply the goods or services to the households. So have a look at this. Expenditure of one becomes income for another. Now I'll explain the same thing using this particular example. For this particular company, for this particular manufacturing company, expenditure or cost incurred is what? Wages. So company is paying wages, and this particular household which has supplied the labor is receiving the wages. It becomes a income for the household. So cost for the company is nothing but the expenditure, that is the wages it has paid. But on the other hand, the households which will receive these particular wages, for the households, it will become income. That is the reason this particular concept of a circular flow is used to explain how the money or the goods and services will keep on flowing into the system or in the economy like this. This particular company would use the labor, and because it has used labor, it will pay wages. It will use land, and for having used land, it will pay rent. This particular company would have used capital. That is, imagine you are starting a company, you will take a loan from a bank. That is nothing but the concept of a capital here. For having utilized capital, it will pay interest. And finally, have a look at this. Company is different and the owner is different. Have you understand this? Company is, let's say, XYZ. You are the owner of the company. So to whom do you think the profits of the company will belong? I'll repeat the statement here. Here is a company XYZ and you own the company XYZ. This particular company, let's imagine, has earned 100 crore rupees this year. To whom do you think these particular profits should go to? Obviously, the profits will go to the owner. So owner would have put in certain efforts. I can understand, just like a labor, owner would have put in certain efforts in this particular company. He has started the company. He is owning the company. So the profits of the company should obviously belong to whom? The owner himself. So this is how the circular flow generally happens in the system. And please understand this. These four factors that I've discussed now, that is land, labor, capital, and entrepreneurship. Entrepreneurship, I used a layman term here, owner. So land, labor, capital, entrepreneurship are referred as four factors of production. And every factor will involve certain income generation. Is it okay? Every one of these particular factors will involve income generation. If I've not understood this, follow this very carefully. You are the manufacturer. You own a company. You will use labor. Imagine I will come to your company and work for you. So for having worked in the company will pay me salary or wages. So the salary or wages will become income for me, but expenditure for the company. That is, company has paid, I have received. And second, you are working or you are set up this particular manufacturing facility by taking land from someone else, or you have rented a particular place from someone else. So after every month you will have to pay certain rent to the owner of this particular place. For the company, the rent becomes an expenditure, it becomes a cost, but for the owner of the facility it becomes an income. Third one, to start manufacturing you have taken loan from a bank, so you'll have to pay interest to the bank. Interest for the company will become expenditure, but for the bank will become income. And finally, you have put together all of these particular resources. You started the company, you hired the labor, you took loan from the bank for the company, you are taking care of the functioning of the company. You would also want certain returns from the company. So the profits which are generated by the company will be given to you because you are the owner of the company. This is nothing but profits debited or basically taken away from the company becomes a cost for it, will be given to you, becomes income for you. So this is a basic idea of the four factors of production. And generally there is a circular flow which happens in the economy. That is the precise reason why I said whether you calculate a GDP through output method, income method, or expenditure method, the income or the value that is generated under three heads should remain same. Now, some of you will basically say how you are connecting this with this, how you are connecting circular flow with the three methods. Let me give a very simple example for this also. Have a look at the first one, the methodology to calculate GDP, output or production based methodology. What do we do under this? Whatever is the total production done in the market into the market value. Is it okay? Whatever is the total production into the market value or market price for that matter. Imagine 10 goods have been manufactured into 10 rupees. I'll put it like this. So what is the value? Total value 100 rupees. That is GDP through output or product value method. But please understand, this particular 100 rupees can be derived by taking into consideration whatever is the inputs put in by the company also. For example, the labor cost. For example, the interest paid. For example, the profits that the company wants to generate, etc. So is it okay if I say that whatever is the market value of this particular product is arrived by taking into consideration the cost incurred by the company itself? Now let me make it much more clearer to you. Have a look at this particular table. I've already discussed the concept of the factors of production. What are the factors of production? Land, labor, capital, entrepreneurship. So on one side, any cost associated with this, I've kept it on the left hand side of the table, and the same value I'll put it on the right side, but that will become income generated in the economy. For example, have a look at this. Imagine this particular company has taken land on rent, it will pay rent, and this becomes the revenue or income for the owner of the land. We already discussed this. I'm putting this in the form of a table. If you take into consideration the factor expenditures on the left hand side, they will be equal to whatever is the factor income generated on the right hand side. What do you mean by this? Imagine rent paid is 10, wages 20 rupees, interest 30 rupees, and profit is 40 rupees. So don't you think it will remain same on the right hand side also? That is the rent, wages, interest, profit will remain respectively same, 10 rupees, 20 rupees, 30 rupees, and 40 rupees. So this side, when I take the sum total, that will give me 100 rupees. Like we have discussed in the earlier slide, that is 10 into 10, 100 rupees. And this side, when I take, this will also give me 100 rupees. But have a look at this. When I calculate the total production from the left hand side of the table, when I calculate total production in the economy from the left hand side of the table, this will give me GDP through output method. But when I take the same calculation from the right hand side of the table, this will give me GDP through income method. As like I've said, there are four factors of production in the economy. That is land, labor, capital, entrepreneurship. Now, whatever is the income generated by all the four individually, I'll repeat the statement. Whatever is the income generated by all the four individually, if you take all these incomes in the system and get that sum total, that is nothing but the total income generated. Now, how do I derive this? Let's take a very simple example. Imagine this particular economy has got only one company, and this particular company has taken land. So on this, rent has been paid. This particular company has taken use of a labor, wages have been paid. This particular company has borrowed money, the interest has been paid, and this particular company or the profits of the company will belong to the owner. So have a look at this. If I take the mini example, or if I take only one example of a particular company, now can I simply say all of these particular incomes are the total incomes generated in this particular economy? Because we are taking a micro module and we are simply saying only one company is there in this particular system. So whatever is the total income generated in the system, either it has to be in the form of wages, or in the form of interest, or in the form of a rent, or in the form of a profit. So if I take sum total of all these incomes, how much will I get? 100 rupees. So when I calculated GDP through production method, value is 100. When I calculate GDP through income method, value is 100. So is it okay if I say the statement now? Whether you calculate GDP through income method or expenditure method or production method, value should remain same under all these particular three methods. Now going back to the original discussion here, there are three methods: output or product value method, second one is income method, and the third one is expenditure method. In case of output method, you take into consideration what is the total production of a goods and services and multiply that with the market value of these particular goods and services. And when I say market value, the present market value of these particular goods and services. That will give you the GDP through production method. And second one is income method. I've given a simple statement there: sum of all the factor incomes. What do you mean by factor incomes? We have already seen in the previous calculation. Factor incomes refer to the rent, wages, interest, and the profit generated in the whole system. Whatever is the sum total of all of this, take it, you will get GDP through income method. And the third one, let me explain this, through expenditure method. What is this idea of an expenditure method? In case of expenditure method, what we say is, from, if you remember the concept of a circular flow, from one side, that is from the company to the households, the money has been flowing in, that is salaries have been paid, and on the company side, the production of goods and services has been done. Now this particular household will utilize these particular incomes to purchase the goods and services which are being supplied in the market by these particular companies. So basically in the expenditure method, we will calculate GDP through how much expenditure has been done in the system. Now before we calculate this, let's have a look at some of the very important concepts first. In any of the economy, please remember this, there's a concept of economic agents. What do you mean by economic agents? Which contribute to the growth. In the Indian economy, let's speak from the context of Indian economy. The economic agents are: one, households; second one is companies. I'm using the term companies. Some of the books will use the term firms. And the third is the government. Some of the books will basically write the fourth one, that is the central banker. I've taken the central banker as a part of the government itself. Now, is it okay if I say that whatever is the expenditure done in the Indian market or Indian economy, either it has to come from the government, or it has to come from the households, or it has to come from the firms or companies? For example, households will spend on consumption of goods and services. The companies will spend on, let's say, investment in the market or production of goods and services, so on and so forth. So any expenditure done in the market, either it has to come from the government, households, or the companies. Now have a look at the first point here. If I take the sum total of the overall expenditure done by all the three, that is, imagine here is a household, it has spent 100 rupees. Here is a company, it also has spent, let's say, it has spent 200 rupees. And here is the government. Imagine this has spent 300 rupees. So 100 for the household, 200 for the companies, and 300 for the government. So overall expenditure done in the economy, in the Indian economy, should be how much? 600 rupees. Is it okay? But here comes a problem. Can I simply say that because this is the overall expenditure done, does it equal to the GDP value in case of India? Absolutely no. Now, if you are still confused how you are connecting expenditure with the GDP, GDP is nothing but the market value of goods and services which are produced in the Indian economy. Now, if these are produced and sold in the market, somebody should have purchased them in the market. It's a very simple concept. If I say GDP is the market value of goods and services, how do I arrive at market value? Because I'm selling these particular goods and services in the market. That is the reason I'm saying market value. So if on one side production is the methodology to calculate GDP, on the other hand, these goods are sold and bought in the market. So how much is spent? That is nothing but the expenditure. So I'm calculating GDP through expenditure method now. So have a look at this. In this example, I've said the households have spent, let's say, 100 rupees. companies 200 rupees and government 300 rupees. If I simply take the total expenditure done in the Indian economy to be 600 rupees, can I say this is the GDP of India? Absolutely no, because there are two very important concepts here. That is, one, follow this very carefully. There are some of these particular goods which have been imported. Is it okay? Some of these particular goods which are consumed either by the household, by the company, or here, these have been imported. On the other hand, some of the production that has been done in case of India has been exported. Is it okay? I'll repeat it again. Some of the goods or services which are consumed here have been imported. But when I say GDP, it should be the market value of goods and services which are produced in India only. And if this particular good, imagine this particular pen has been manufactured in USA and we have imported into India and I'm consuming this particular product right now. Again, consumption, do not take it literally. I'm using this particular pen. So I'm using this particular pen or consuming this particular pen. But can I simply say that this is India's GDP? No, this is not part of India's GDP for a simple reason. GDP considers only those particular goods and services which have been manufactured in India. Has this pen been manufactured in India? Absolutely no. This has been manufactured in USA. So have a look at this. There have been certain goods which have been imported into India, and these particular goods or services have been consumed either by the government or by the households or by the private sector companies. So when these particular goods or imports have been consumed and these are part of 600 rupees, how can I consider that as part of India's GDP? I will have to correct it. Is it okay? In simple terms, out of this particular 600 rupees, I'll have to subtract the value of imports. Is it okay? Let's assume the value of imports is 100 rupees. So now can I simply say that total expenditure in India is 600 minus 100, 500 is India's GDP. Can I simply say this? Obviously no. There is one more correction required. What is the second correction here? Have a look at the left side now. The goods which are produced in India or the goods and services which are produced in India are part of India's GDP. Done. But some of the goods which are produced in India or some of the services which are produced in India have been exported. So when these particular goods or services have been exported, can they be consumed in India? Follow the question very carefully. When these particular goods or services are exported, let's say to USA, these have been produced in India, yes, but they are consumed in USA. So since these are consumed in USA, do you think they are part of India's consumption here? No. So how can I simply say that 500 is the GDP of India? Absolutely no. I'll have to consider 500 plus I will also have to add exports which are done from India. So have a look at this. I've watered down the concept into 2 points. One, 500 represents goods which are produced in India as well as consumed in India. And the second component is the goods which are produced in India but are consumed outside India. But essentially GDP is a measure of what? The market value of goods and services which are produced in India. Since these are produced in India and these are produced in India, the sum total will give me the GDP through expenditure method. The same will be given in the form of a formula. Have a look at this. The expenditure method formula for GDP calculation is C plus I plus G within the bracket X minus M. Let me elaborate on this. C represents the expenditure done by the consumers. That is basically households. I represents the investment expenditure done by the companies or firms. And finally, G represents the expenditure done by the government. So this will give me what? Total expenditure done in India. But out of this, there are certain goods which have been imported and consumed. I will have to subtract it. M represents imports. And now this will give me what? The total value of goods and services which are produced in India and consumed in India. One more component is missing. Those goods and services which are produced in India but are exported. Here the component is represented in the form of X. X is nothing but exports. And this particular formula within the bracket X minus M, net exports. Do not get confused. If they have simply written net exports, it represents the exports minus imports like this. So these are the three methods. GDP, gross domestic product, is the market value of all the goods and services which are produced in a specific territory for a specific time period. This can be measured under three heads. Irrespective of which measure or which formula you are using, the GDP value will simply remain same. The three methods are: one, production or output value method; second one is a income method; and the third one is expenditure method. And who will publish this particular GDP numbers for you? Officially, it is given by National Statistical Office or NSO. Some of the books would have written CSO, but please make a correction. Earlier, there were two organizations, NSSO, National Sample Survey Organization, and a CSO. CSO used to publish the GDP data, but Government of India has basically merged both of them, and the new entity is NSO. I've just given a particular table for the reference here. Do not have to mug up any of these particular numbers. I just want you to understand how NSO will publish the data. Right? This is basically representation of the data which is given in the NSO report. Have a look at this. Right, for 2017 and 2018, the 2018 and 2019, right, basically PE refers to as provisional estimates and A refers to advanced estimates. Again, not important for UPSC. What you need to understand is this particular part of the table is nothing but GDP through production method or output method. And this particular part of the table, it should not surprise you because the term expenditures is used. It is a GDP through the expenditure method. But more importantly, have a look at the GDP value under both of these particular different calculations. GDP here and GDP here. Again, you don't have to mug up the numbers. If you see these particular GDP numbers, these are same in both of these particular tables. That is the reason earlier I stated, irrespective of whether you calculate GDP through production method or output method or income method or expenditure method, the GDP value will be same under all of these three heads or three calculations. Now within this, understand this, one point of a discussion which is very important for your exams is the GDP methodology. That is, how do you calculate GDP? Yes, we have seen the three methods, but we have seen all of them in brief. But within this, one particular methodology is there in the discussion and which is very, very important for your UPSC exams. That particular methodology that I'm actually referring to is a GDP through output method or production method. Okay, what is exactly the process? How do we calculate GDP either through output or production method? As of now, what we have seen, simply the formula. Total market value. How do we derive this? The total output into the market prices. That's very simple, right? So how do we actually arrive at this particular formula? The whole process is very important, and this has been there in the newspapers for the last couple of years. So let's have a discussion related to the GDP calculation using production or output methodology. How do we calculate it? Understand this very carefully. The new method of measurement will be the one that we'll be discussing now. First and foremost, the base year has been changed from 2004 and 5 to 2011 and 12. Again, the concept of a base year will be changed every now and then, right? Generally, we say that once every 5 years, we keep on changing the base year. Again, there is a discussion with respect to changing the base year again very recently. If it is done, please update it. However, understand this. What do you mean by the concept of a base year here? Now, before I tell you what is the idea of a base year, let me give a very simple example. I'll tell you that there are two students, X and Y, and I'll simply say X has scored 300 marks and Y has scored 500 marks. And I'll put a question to you. Tell me which of the two students has scored better in the exam. Most of you will simply say, sir, Y has scored better because he has scored 500. But now I'll tell you, what if X has scored 300 out of 500 and Y has scored 500 out of 1000? Which one has scored better? Your answer will shift to X. This will happen for a simple reason. You assumed that both of them were studying in the same class and both of them were appearing in the same exam. I had not given the data to you. But once I give you the base here, once I give the base for you to compare the marks with, now you will have a better idea of who has scored better in the exam. In the same way, what is GDP? GDP is the market value of goods and services which are produced in a particular time period in a particular territory. Now, I'll simply tell you the statement that imagine India's GDP is $2.7 trillion. In fact, it is somewhere around $3 trillion now. I'm just giving you past data. I'm telling you, imagine this year, India's GDP is nothing but market value of goods and services. So that value is $2.7 trillion. Now, based on this, what information you can derive from this particular data. Apart from the fact that, yes, India's GDP value is how much? $2.7 trillion. Can you derive anything else? Yes, I know you will make a comparison with other countries and you will say India's GDP is much bigger. In the same way, India's GDP will also be much smaller compared to countries such as China as well as USA. That is not the point here. I'm simply asking you, only this data is given to you. What information can you derive out of this? Nothing beyond the fact that it is the value or it is of the value of $2.7 trillion. But what if I say last year for the same economy, the GDP value was $2.5 trillion. Now have a look at this. You are comparing the present value or the value of GDP in the current financial year with the GDP value of the previous financial year. And now you will be able to come to a conclusion, yes, sir, in the past 1 year, India's GDP value has increased. Again, some of you will convert that into percentages and you will give the data in terms of percentages. But that's not the point here. Point is, GDP simply looked is nothing but the market value. But how do I come to a conclusion whether the market value is good, bad, or needs improvement? That information can be derived only when I make a comparison of this GDP value with a certain base. For that, we use a concept of a base year. Generally, what happens is from the base year to the current year, follow this very carefully. From the base year to current year, the market prices of the goods would have changed. For this, there is a concept called as an inflation, which we will be discussing further in a separate module. But as of now, follow this very carefully. Inflation basically refers to increased price level for a basket of commodity. I'll repeat the statement. There is a basket of commodity, that is group of goods as well as services. For this particular group of goods and services, how much I'm paying today is much higher or is higher compared to how much I was paying, let's say, last year or a year before that. And this particular increased price level is referred as inflation. Again, as of now, remember only this. When I take up inflation in detail, we'll have a look at how it is calculated, what is the importance, and so on and so forth. What I'm trying to say here is, from the base year, imagine the base year is 2011 and 12. In the base year to present situation, financial year, let's say 21 and 22. Don't you think because of inflation, the market prices would have been higher? That is a precise reason. There are two concepts of a GDP. First, you come across a term called as nominal GDP. And second one, you come across the term called as a real GDP. And if you're reading the newspaper, you must have come across this. Nominal GDP growth rate, real GDP growth rate, so on and so forth. What is the basic idea? If I take the current market prices and then calculate GDP, that GDP is referred as a nominal GDP. But if I take constant prices means what? From 2011-12 to, let's say, financial year 2022, the prices have increased because of inflation. Now, whatever is the inflation or whatever is the price rise because of inflation, I'm going to subtract that. Is it okay? So imagine in the base year, the price was, let's say, 10 rupees. But after that, there has been inflation. Because of inflation, this particular 10 rupee price would have increased. So I will calculate what has been the inflation rate in the base year or between the base year and the current financial year. And I will subtract the impact of inflation on the market prices to go back to the base year prices. So whenever I will calculate the GDP by taking into consideration the current market prices, we'll simply call that as a nominal GDP. And when I calculate GDP using the constant prices, that is basically drag back the price levels to the base year and take out the impact of the inflation, that price is called as a real GDP, right? Or else some of the books will also tell you that is nominal GDP will also be referred to as a GDP at current prices, and a real GDP is nothing but GDP at constant prices. Now, apart from this, with respect to concept of a base year, how the base year is chosen, on what parameters the base year is chosen. Generally, understand this: year with very low volatility, a year with very low volatility is generally chosen as a base year. Now you'll ask me, sir, what do you mean by very low volatility? Understand the logic here. If you take the example of 2020, I'm pretty sure all of us have lived in this particular year. Now, is it okay if I say that 2020 was not a normal year? There was a pandemic. It caused a disruption in the whole economy. Production was affected. Services were affected. Financial sector was affected. So understand this. Whenever such kind of a disruptions are caused, whenever disturbances happen in the market, we generally use the term volatility. So we are choosing a particular year as a base year in which volatility is very, very low. Can we take 2020 as a base year? Obviously, no, for a simple reason. This was not a normal year. The economy was affected in all the sides because of the pandemic. So, idea of a base year is the year where macroeconomic data is available, such as employment, unemployment data, population data, inflation data, so on and so forth. And in addition to this, that particular year should have very, very low volatility. The market should not be very volatile. If it is, then that year is generally not chosen as a base year. Because please understand this. Let's take a simple example. Imagine for the year 2020 and 21. This is a financial year 21. So have a look at this. In the financial year 21, obviously because of the pandemic, GDP will be lesser. Now imagine, because of the pandemic, the GDP had declined to 100 crore rupees. And generally, in case of India, GDP was growing, let's say from 110 crore to 120 crores to let's say 130 crores. But because of the pandemic, in financial year 21, it has fallen down to 100 crore rupees. Now, if I take this as a base year, even if in the next year we generate a GDP of 105 crore rupees, have a look at this particular GDP with the previous year's GDP. Obviously, it is much lesser. But now what we have done, we have taken this as a base year. So it will seem that India has registered a growth rate of 5%. GDP has grown by 5%. But in reality, what would have happened? GDP would not have increased. Rather, it is much, much lesser than what was the previous levels of GDP. So that is the reason the concept of a base year is very, very important. And understand this, I'll introduce another concept here. There is a term called as a base effect. Again, we'll come across the concept of a base effect when we discuss inflation. But as of now, whenever the base against which we are making a comparison is abnormally lower or higher, is it okay? Whenever the base against which we are making a comparison is abnormally lower or higher, obviously the data will also be affected by this. Is it okay? I'll repeat it again. Whenever the base against which we are making a comparison is abnormally low or abnormally high, it will definitely have an impact on the outcome. What is the outcome here? Outcome here is GDP growth rate for next financial year. But have a look at this. If I take the GDP growth rates in earlier years or GDP value in earlier years, the GDP value was 110, 120 crore, 130 crores. Now, if I change the base year to 2021, that is financial year 21, where the GDP value is 100 crore rupees, even if I achieve a GDP of let's say 105 crores or 110 crores, it will show a GDP growth rate. But has the economy actually grown? If you compare this data with the earlier years, no, economy has not actually grown. In fact, we have reached the earlier levels of let's say 110 crores, which in effect simply means we have lost 1 year, second year, third year. We have lost 3 years. So we have returned back to the 3 years ago's data as such. So this particular concept is referred as a base effect. Remember this. This is also there in the discussion in the current affairs. Done. So first very important change that we have done in case of a GDP methodology is what? We have changed the base year. Second, we are following a system of calculation which is referred as a systems of national accounts. This was introduced by United Nations and most of the countries are basically following this particular methodology only. Now, what has been the methodology? We'll have a detailed discussion related to that in some time. This has been ratified by international agencies such as World Bank, IMF, OECD, etc. And India has basically adopted this particular methodology in the calculation of GDP now. Now, how the method has been changed? What is the new method of measurement? First, understand this. Coverage has been shifted from ASI, Annual Survey of Industries, to MCA 21. MCA stands for Ministry of Corporate Affairs. Now, what do you mean by this? Let me give a simple example here. What we are doing is, we are calculating GDP through production method. Now, imagine this is the economy and there are two companies, A and B. Okay, I'm taking a very simple example. In this economy, how many companies are there? Two companies. Now, if I want to calculate what is the GDP through production methodology, I need to collect the production data from A as well as B. Imagine company has produced 10 goods, company B has produced 20 goods. Total production will be how much? 30 goods. And if the market price on an average is 15 rupees, then the GDP will be how much? 450 rupees. Is it okay? I'm just giving a very simple example here. It's not so easy, in fact. So what we have done in the economy, we have assumed that there are two companies. And from each of the company, I've collected the data. I means NSO has collected the production data and it has taken the market price and it has multiplied the production output into the market price to arrive at the GDP value. But please understand, in case of India, there are lakhs and lakhs of companies. Do you think it is possible for NSO to keep on going to every company to collect the data like this? Not possible. So rather than this, what we do is we use a methodology or we are using a system wherein we have identified lakhs of companies and we are telling these particular lakhs of companies which have been identified, which is more than 3 lakh companies right now. We have asked these particular companies to report their production data to NSO for a simple reason. Large number of these particular companies are basically unorganized in nature, informal in nature, which simply means these are not registered, these are not coming under the coverage of any of the laws of the government. In such a situation, how can you collect the production data from all of these particular companies? So what we generally do is NSO has identified 3 plus lakh companies and these particular companies should report the production data on monthly basis to NSO. This methodology of collection of production data is nothing but MCA 21, Ministry of Corporate Affairs 21. Apart from this, it is also part of e-governance initiative of Government of India. Now, what was the earlier system? Earlier, there was an annual survey which was conducted considering more than 1 lakh companies. This particular survey was referred as Annual Survey of Industries. So earlier, the production data from the companies was taken from the concept of a ASI. Under the new methodology which has been introduced post 2014 in case of India, rather than taking the production data from ASI, we have shifted to the concept of a MCA 21 production database. That's the first very important change. Second very important change, we have shifted from cost price method to market price method. What do you mean by this? Let me take a very simple example. Imagine I am the person who is manufacturing this particular pen. Okay, I'm not, but imagine. So imagine I'm manufacturing this particular pen. To manufacture this particular pen, I will incur, let's say, a cost of 20 rupees. Is it okay? I'll incur a cost of 20 rupees. If I simply take this input cost or the cost price, basically what I've done, I've incurred cost to get raw material, to get electricity, to get labor, to purchase machinery, and considering all of this, I'll simply say how much I've spent to manufacture this particular pen. 20 rupees is the expenditure. If I simply assume this particular number represents a concept of an input cost or cost price. Is it okay? This particular 20 rupees is nothing but input cost or cost price. It includes even profit also. Right? Don't ask me, sir, where is the profit? If you remember the concept of 4 factors of production, right? There's a component of a profit already involved. So assuming everything, what is the cost price here? 20 rupees. But have a look at this. I've manufactured this. Is it okay if I say that before I sell this particular product to you people, government will come into the picture and say, pay me indirect taxes. Indirect taxes are those which are generally imposed on production or consumption. We'll discuss indirect taxes in detail under the ambit of taxation. For example, you must have heard of a central excise tax on petrol. You must have heard of a VAT value added tax. You must have heard of a sales tax imposed by the state government, or the most famous right now, goods and services taxes. Right? For example, you go to a market, you want to purchase soap, pen, right, or any product in the market. Right? Generally, there's a component of an indirect tax. That is the idea of an indirect tax. So have a look at this. I have manufactured this. I've incurred a cost of how much? 20 rupees. Now, in addition to this, government will come into the picture and say, pay indirect taxes. Now, understand this very carefully. Imagine the indirect tax is 5 rupees. So, if I consider only 2 parameters here, what will the selling price? What will the market price? 20 rupees plus 5 rupees, 25 rupees. But there is a third component here, that is subsidies. Now, what is the idea of a subsidy? Subsidy is the financial assistance provided by the government. Is it okay? Subsidy is the financial assistance provided by the government. Right? For example, government will provide the assistance to the households, right? For LPG, there is a subsidy. Government will provide a financial assistance to the manufacturers. Government will provide a financial assistance to other stakeholders in the system also. For example, fertilizers subsidy, there is irrigation subsidy, so on and so forth. So in essence, what is subsidy? Subsidy is the assistance provided by the government. But understand this very carefully. Imagine the same pen, if I've incurred a cost of 20 rupees, if government of India says, if you manufacture this particular pen in India, I will give you a subsidy of 2 rupees. Is that okay? The cost, which is 20 rupees for me, if I get a subsidy of 2 rupees, can I simply say my cost price will come down? Rather than incurring a cost of 20 rupees, now I've paid 20 rupees for this particular pen, but government will give me 2 rupees. So what will happen to cost price? The cost price will automatically come down. So have a look at this. Before arriving in the market, before I sell the product to you people in the market, first I'll have to consider what? Cost price. Second, government will impose certain indirect taxes. In addition to this, government will also provide certain subsidies. Indirect taxes will add to the cost price, will increase the price. Subsidies will reduce the price. Remember this. So in this particular example, 20 rupees is the cost price. Indirect taxes 5 rupees, 25, and the subsidies is 2 rupees. So net effect of all of this, I will sell the pen to you at 23 rupees. This particular 23 rupees nothing but market price. Is it okay? This 23 is nothing but market price. So this is the basic idea of a cost price and the market price. So earlier, before 2014 and 2015, we used to calculate GDP taking the cost price. But post the new methodology, we have started taking the market price and we are calculating GDP through market prices only. Is it okay? Remember this particular change which has happened. Third, we have shifted to concept of a GVA now. We'll discuss. We have shifted to concept of a using GVA. What is this GVA? But before that, there is also another statement here. Earlier, we used to use IIP. What is the meaning of this? IIP stands for Index of Industrial Production. It is one of the very important parameters to measure what is the increase in the output. Now, again, we'll have a look at this under the industries concept, but as of now, simply understand this. Under the concept of index of industrial production, what generally happens is, imagine in one of the years, we have produced 100 goods. In the next year, the output increases to, let's say, 120 units. Then as per IIP, basically, the IIP is nothing but 20% here. So, by what percentage volume of production has increased? That measurement is nothing but index of industrial production. So earlier, before 14 and 15, whenever the GDP was calculated, we used to use IIP. But now what we have done? We have shifted from usage of IIP to usage of the concept of GVA, gross value addition, in the calculation of GDP.